big welcome to everybody who's joining us this afternoon. Big welcome, obviously, to my colleagues at CDC and also to the many other people who are joining this call. And of course, especially big welcome to our guest speaker, Sir Ronald Cohen. And I know for many of you, Ronnie will not need much introduction, but I will try to give you some sense of Ronnie's background. He has had an extraordinary life. He began life in Egypt, was expelled with his family from Egypt in his early teens, came to the UK with very little money, speaking almost no English. 8 years later, he was not just speaking English, but he was president of the Oxford Union. After graduating from Oxford, he went to Harvard Business School. After leaving Harvard Business School, he started the firm that became known as Apax. Apax became, under his leadership, over the next 25 or 30 years, the largest private equity and venture capital firm in Europe. And I think you'd sort of say, if Ronnie had stopped then, that would have been a life of extraordinary achievement. But it's actually what Ronnie has done since then that has really been really most extraordinary. He was asked in 2000 by Gordon Brown, then Chancellor of the Exchequer, to chair what was known as the Social Investment Task Force. And the mandate of that task force was really to explore ways in which capital could be used and mobilized to address social issues. And that really became the beginning of what has grown into the impact investment movement. Ronnie, over the next 10 years, founded 3 companies: Bridges, which was really the world's first social investment private equity firm; Social Finance, which developed the world's first social impact bond; and Big Society Capital, which was the world's first social investment wholesaler. All of those companies, and I can speak from personal experience, all of those companies were incubated in Ronnie's basement in Portland Place, and a very nice basement it was too. I'm gonna probably very few people have heard Ronnie speak as much as I have over the last decade. So I can tell you in advance that he is always a visionary. He is, as I said, the creator of the really the godfather, the creator of what is now the global impact investment movement. He's always inspiring, and it's really a huge privilege to have the opportunity to have him speak with us today. So with that, I will hand it back to you, Colin, to pose some questions to Ronnie.
So thanks very much, Nick, and welcome, Ronnie, to CDC.
Hello, Colin.
So as Nick mentioned, I mean, you are a pioneer of the impact movement, and you've been championing it now for over 2 decades. But before we go into some of the details, maybe we should start from first principles. And so remind us why we need an impact revolution, and what is it about now which makes you think its time has come?
Well, wonderful to be here with you, Colin, and the CDC community, and a great pleasure, Nick, to share a meeting with you. We worked so closely together for so many years now, more than a decade, to set up Big Society Capital and lead the impact movement. And it's a great pleasure to be sharing the platform with the Dolliker Banda. And I very much look forward to sketching out with Dolliker the importance today of impact investment as we recover from COVID and have to meet hugely magnified challenges. And the answer to your question, Colin, is that our system, our capitalist system, has become self-defeating. And all of us on this webinar realize it. We can't manage to cope with the scale of the social and environmental challenges we face. And the reason is that the search for profit and ignoring all of the consequences of the actions that are taken in achieving profit is a very complicated system which leads to really huge social and environmental costs. And what we're talking about with impact investment is bringing a third dimension to risk and return, bringing the dimension of impact. We can measure impact today. Even a decade ago, we couldn't measure the impact of companies, the impact that their operations create on the environment, that their employment creates on people, and that their products create on people and the environment. But technology today enables us to do so. And so it presents us, Colin, with the opportunity to turn our system into one that is capable of bringing solutions to our great challenges, to improve our society, to make it fairer, and at the same time, to protect our environment.
So thanks, Ronnie. I mean, one of the things about investing and finance is that there is almost an intellectual purity around it of profit maximization. No matter what you do, you can always reduce financial success down to profit. And by comparison, impact seems a little nebulous. You mentioned that it's easier to measure, but there are many different impacts and there are many different kinds of measurement. I mean, why should we demand of investors who are used to this kind of singular focus that they should now adopt this more nebulous approach to investing behavior?
So the reason is because we're seeing a convergence of three very powerful trends. The first, which hasn't been lost on any of us on this webinar, is that values have changed. Consumers and talent no longer want to purchase or to work for companies that are destroying the environment or using child labor. And this hasn't been lost on investors because the implications for the success of their investments are huge. And so investors are now channeling $40 trillion to achieve more than profit through ESG investment and $1 trillion to impact investment where the impact is measured as well as having the same intention as ESG. So that is one massive trend which changes the rules of the game in terms of acquiring clients, talent, and the support of investors. The second massive trend is something that humanity has never been able to contemplate before, which is using our new technologies, which have taken a huge leap forward, artificial intelligence, machine learning, augmented reality, and many other technological leaps that enable us to deliver impact globally at a scale we could never have contemplated previously. And the third one is technology giving us a breakthrough in the measurement of the impact of individual companies, turning them into monetary values that can be reflected in their financial accounts. And so the rules of the game have already changed for investors and companies. If you look at ESG investment, it has already tilted the scales in financial markets in the sense that you can see a correlation in the data at Harvard Business School in its impact-weighted accounts initiative, which I'm privileged to chair. You can see there in data about the environmental impact of 1,800 companies, where a higher level of pollution leads to a lower valuation relative to competitors. So the rules of the game have changed for companies, and companies are beginning to feel the pressure to create transition plans. We're now talking openly about companies publishing transition plans to net zero. Well, we're going to have the same thing with regard to diversity and differences in gender pay and advancement of minority groups within companies, and so on. We're seeing shareholder revolutions. At the Procter & Gamble shareholder meeting just a month or so ago, 2/3 of shareholders rebelled against management because of what? Because of the deforestation that P&G is creating through its use of palm oil. So the rules of the game have changed, and the goalposts now involve, on the one hand, achieving profit, and on the other hand, at the same time, delivering positive impact.
So you've alluded to two kind of rhetorical tools that could be used in convincing financial professionals to start adopting a broader notion of impact. One of them is the relationship with, ESG outcomes and financial performance, but that's really only one subset of impact. And the other one is, shareholder activism. But I'm wondering if there are other tools or broader messages that are in the long run going to compel this shift over to adopting impact investing broader.
A very good question, Colin. The most powerful push is going to come from the fact that optimizing risk, return, and impact actually delivers better financial returns. Now, with the change in values that we've witnessed, than just optimizing risk and return. So it's not surprising that you see fossil fuel valuations crash in 2020, while the market cap of Tesla multiplies by 7, and clean energy ETFs multiplied by 2 or 3 times. So the dynamic which has been created now is one where companies like Tesla can aspire to have greater market valuations than several of their competitors put together, 5 competitors put together. And investors are beginning, with the changing view of short-term profitability that has come from technological development and the big tech companies, which have established business models that have led to years of losses before effectively imposing a monopoly on the whole of their market. Investors are beginning to draw correlations between impact and future growth and performance. And that is what is going to drive impact entrepreneurship and investment in public markets.
So to hear you describe it, I mean, it's almost like, efficient market drivers would drive us to impact investing. And yet impact investing has been very much on government policy initiatives, and you yourself have sat on a number of them, kind of informing of it. So what's the role then of government in promoting impact investing?
Well, as I say in my book, Impact, Reshaping Capitalism to Drive Real Change, we need governments to play an enabling role. We can't rely on investment markets and entrepreneurial efforts alone to bring about this massive paradigm shift. And what we need government to do, Colin, is to bring the tools that enable $40 trillion of ESG investment, where, as I said before, investors are trying to achieve impact on top of profit, but nothing is measured. And very general reporting of selective information that shows companies in a good light seems to be the rule rather than the exception. To bring that to the same standard of disclosure and accounting practice that we see with regard to transparency on the profits of companies. So the biggest thing that governments can do today, at a time when they need to bring private sector money and the resources of companies to help meet the huge challenges we're going to face post-COVID. And we're going to be facing them, of course, at the time when government resources are more constrained than ever because of huge government debt. Governments need to bring investors and companies alongside to meet challenges with them. And the most powerful tool they can use is the tool of transparency on impact by making it mandatory that companies publish, starting 3 years from now, impact-weighted accounts that reflect in monetary terms the impact of companies through their operations, their employment, and their products. Now, we have a historical parallel with 1929 and the ensuing years, because in 29, at the time of the Great Crash, investors had very little transparency on the profit of companies. Every company, as you know, picked its own accounting principles, and there were no auditors to verify the numbers. And the US led the world by imposing generally accepted accounting principles and auditors in legislation in 33 and 34. We need governments to do the same about impact transparency today. And if governments will do that, they will enable financial markets to shift the behavior of companies to achieve the results that we all need, which is greater sharing of prosperity, a reduction in economic and social inequality, and preservation of our planet.
And maybe I should drop a footnote here that this notion of impact-weighted accounting is is both provocative and very well worked out in your book. And I would urge anyone who wants to investigate it further to sort of go to those parts of your book. But maybe if I can spread this out a little bit, because now we've identified free market drivers towards impact investing. There is a role for government, which you've identified as essentially being transparency, reporting, playing the same role that it has in securities regulation. But there has grown up over the last couple of decades an enormous, what we would call, impact investing ecosystem. So let's talk about the other parts of that. What are the other players that have to come into effect here to move impact investing forward to become, the status quo?
Well, the first and most important one is to get investors to allocate capital to achieve impact. The supply of money creates its own demand. I was fortunate to be able to benefit from that at the time when the venture capital industry started. As soon as regulation changed in the United States in 1978 to allow pension funds to invest in venture capital and indeed to report on the reasons why they hadn't invested when they didn't, that led to the size of a venture capital fund multiplying by 10 from $2.5 million, yes, that's how small they were when I got started, to $30 million just a year later. Now, there's $38 trillion invested in pension funds across the world today. We have to bring pension fund investors and other asset owners alongside the asset managers who have led thus far in deploying capital into ESG and in part into impact investment. And so what we need is for government to begin to change the regulations around the duties of trustees of pension funds and endowment staff to allow this massive capital to flow. We can see new funds being launched in private equity and in venture capital, in property even, and in infrastructure, which have an impact mission today. And the measurement of impact is obviously less of a challenge when you're dealing with single product, smaller companies than it is when you're dealing with massive global conglomerates. We've seen that happen, but we have to bring it to the public markets as well, to the stock market and to the bond market. Now, interestingly, in the bond market, we're beginning to see bond issues by companies like Novartis, where the rate of interest on the bond is actually reduced if the company achieves certain social objectives. In the case of the $1.8 billion Novartis bond, as you well know, these objectives are that these drugs that Novartis produces should reach the most vulnerable. And we're seeing that happening in green bonds as well. So we want to provide incentives for that. We're seeing sovereign governments like the German government saying that they have an objective to issue $39 billion worth of green bonds just in this year. So the bond market is beginning to go in that direction, and we're going to see blue bonds and education bonds and brown bonds that deal with the soil and so on and so forth. But there's 100 trillion invested in stock markets today, in stocks and shares. And if we can turn that 40 trillion of ESG into impact investment because we measure it, then we really do change the ecosystem. Because the pension funds that we want to attract in are very big purchasers of public securities, as you know, and giving them the ability to make discriminating choices between managers because they can manage both the profit and the impact of their portfolio by picking their managers is a huge change in the investment paradigm.
Great. So I'd like to widen out our conversation now by inviting and introducing Dalika Banda to join us. So Dalika is a global ambassador of the Global Steering Group for Impact Investment, which you know, and so you know her very well through that. She's also held non-executive director positions at EcoBank Transnational, Harith Infrastructure, and the DFID's Financial Sector Deepening Africa program. She's a Zambian national based in Lusaka with over 25 years experience in international finance and banking. She's a former director at the IFC, and I'm very proud to say a former regional director for Africa at CDC Group, and presently one of our non-executive directors. So Dalika, welcome. If I can start, Dalika, with a question. I mean, you've been hearing Ronnie's views about impact investing, and this movement truly started, I think, in the United States and mostly in Western Europe. But I wonder if I could start with your thoughts about how impact investing is playing out in the emerging market context, and in particular in developing economies.
Ronnie, good to see you, and great to be, as always, an honor to be on the same panel as yourself. So I think, Colin, at the beginning of the conversation, you asked, Ronnie, has impact investing come into its own time? This is a term that I have been using extensively for the last 12 months, I should say, particularly since COVID landed on our doorstep. So I think this is not just of importance in its regions of nascence, Europe and North America. It has actually come to a point where, for Africa, I think we can even just drop the impact component and just say impact investing is what investment is about. It is a generic term that is the requirement for growth capital in continents, and I speak for Africa, but I also speak globally. I speak for South Asia, Bangladesh's of this world, in the sense that this has got to be a call to action to actually put money into very creative minds. And for me, it truly is now about the delivery of two things: the delivery of capital and the delivery of technical assistance, giving people the capability to scale and upscale their own businesses. So I believe that for emerging markets, this conversation is extremely critical. I think it is particularly critical in the face of COVID, but I would highlight, as investors and hard-nosed investors, that COVID is not the imperative that we should be talking about. COVID merely highlighted fault lines that were there already. And these fault lines to me suggest we need to start thinking, and I think people are already thinking across three dimensions. And those three dimensions for me is an integration of everything that we're talking about, which is foreign policy, development, and investment. These three are coming to a confluence in terms of, are we creating the world in which we want to live, especially as the borders become porous, especially as information becomes ubiquitous, especially as the previously blinded or uninformed and inexposed populations of emerging markets through technology become much more informed, much more aspirational, and fundamentally a much bigger component of our global society than ever was the case before. So in 2030, out of a global population of almost 9 million, we will have 50% of that in women, and we will have 50 to 60% of that in youth. And the youth for me is actually in emerging markets, the middle class. What we are terming the middle class today, these are the new middle class. So is it important? Yes. When was there ever time? The time is now. And I think there is the opportunity, there is the risk, but within risk is also a huge opportunity from an investment perspective. Let me leave it there, Colin. I know we'll explore this a little bit more.
Well, let's thank you for that, Dalek. And let's focus a little bit more, because as you know, one of the emerging issues in development is a focus on the most difficult economies, often referred to as fragile and conflict states. Is there something fundamentally different in the calculus of impact and risk and return in those countries that makes impact investing either more useful as a tool, or in fact less apposite in those kinds of economies?
So I think for investors, we are wired in a certain way. We are wired in a way that our first instinct is to identify the risk. And then our second instinct is to say, okay, can I make this risk work vis-a-vis the upside or the reward that I am looking at? And usually the risk overshadows the opportunity. Now, we speak about, there are some more fragile countries, even within the fragile already emerging markets. But to me, the conversation should be much more, there's two sides to this conversation. From the investor perspective, the conversation should be much more about, do I see an opportunity in this situation that fits with my vision and my mission? So for some investors, I hate to mention countries, but for some investors, certain countries in certain parts of Africa would be extremely dangerous, no-go areas. For other countries, those may be the very areas that their mission and their mandate drives them to. And that opportunity and that reward is tied to your mission and your vision. And there are enough players in this world, we know there are players who go to Nigeria, as well as players who go to DRC. These are both risky countries, but very different types of risks that we're dealing with. But there is an appetite for both of those. There are players who go to Myanmar. There are players who go to Bangladesh and India. Different types of risks, different appetites, but still the people are there. And I think the work we have to do is say, okay, what is the opportunity? What is the reward? What is the upside? And therefore, how do I then use this opportunity by looking at my risk component and saying, how can I structure for that risk? How can I price for that risk? How can I use different investor appetites to credit enhance? Ronnie talked about pension funds. These are credit enhancement tools that can de-risk the structure a little bit. But on the other hand, Colin, is what I call the sovereign responsibility. I think that for too long, we as a global world have been too lenient on the miscreants, if I can put it that way, of certain governments. Let's be blunt about it. Now, when you are bringing money, whether you're a donor or whether you're an impact investor or whether you're a non-impact investor, you are looking for a reward. You are looking for a certain outcome. And that outcome has got to be demonstrated. We have governments that are very ready to take money in, not just in emerging markets, in many markets, that are very ready to take taxpayers' money, but are not ready to be accountable for the use of that money and for the outcomes of that money. And that's why I really like the impact-weighted accounting that Ronnie is pursuing, because at some point, we must be able to say, our impact has been to alleviate poverty and to enhance inclusion, and we have been able to do it through this, and that has got to be the outcome. So we have got to reverse the way we behave and think about the outcome and hold our host governments accountable for those outcomes.
So thanks, Dalika. Ronnie, let me take this back to you, because I mean, Dalika suggests, and accurately so, that there are different investors for different investment markets. But I think if we looked at the pool of impact investors, very few of them are really investing in developing countries. And I guess two questions there. I mean, one is that in a way an indictment of the impact side of impact investors, that they're shying away from these markets? And is there something that can be done to sort of drive more impact investment flows out of developed markets and more into developing countries?
So, Colin, the big change with this pandemic and the economic crisis it has occasioned is the arrival of impact. Now, impact affects the behavior of investors, and we've dwelt on that primarily, but it also affects the behavior of aid and philanthropy and of corporations. So to the extent that new instruments are coming along now, just as venture capital and investment in tech on public markets came 50 years ago, to the extent that new forms of investment are coming along now, investors are going to be prepared to pick them up because they will deliver better returns, basically. And in the case of pension funds, it's what their pension savers want today. In the case of wealthy families, it's what the younger generations want. So the question then is, okay, so what is going to be the scope for aid and philanthropy to play a different role than they have previously? Well, what impact has brought to aid and philanthropy is new approaches that are based on attracting investment money to deliver attractive risk-adjusted returns on the basis of achieving social goals through pay for success. I'm referring to social and development impact bonds and the outcomes funds opposite them that aid and philanthropic and government organizations, the outcomes funds, that those three donors are able to put in place so as to attract investment to the delivery organizations, be they NGOs or profit with purpose businesses, to enable them to scale and innovate in improving some of our greatest issues, the issues around education, the issues around women, the issues around employment, and the issues around the most vulnerable who live in slums. So to the extent that we create, as philanthropists and aid organizations, outcomes funds of $1 billion or more in many countries to attract investment capital to deal with these issues, there are going to be opportunities for investors to make risk-adjusted returns of 4 to 10% in dollar terms, which are uncorrelated with the stock market or even interest rates. Now, the whole world is looking for uncorrelated investment delivering these types of returns. So you can see how new products create new appetite. But then I want to come to perhaps the biggest challenge before us. The biggest challenge before us is to change the behavior of companies so that, like Novartis, they begin to set impact objectives. Now, to the extent that impact accounting, such as is being carried out at Harvard Business School, demonstrates that you can measure the product impact of a company because you can have information today about the customers who are being served by these companies. And you can measure the amount that is going to more vulnerable consumers rather than to the well-off consumers in developed markets. That combination of risk, return, and impact will be attractive for some companies and for the investors in them. They will also lead these companies to direct investment to emerging markets because their attempt to deliver impact can't just be through the export of products. It makes more sense for them to build facilities in these countries. And it's one of the things, for instance, in our response to COVID, through testing capacity that needs to be local, or vaccination capacity that needs to be local. It's one of the mechanisms that the impact movement has been trying to persuade governments to use. So I think the ecosystem to which you've referred that is being created now will create incentives for companies and for aid and philanthropy to begin to give opportunities for investors to optimize risk, return, and impact. But if we don't have rigorous measure of the impact created, we're all going to be victims of impact washing of one kind or another. And so bringing this transparency is hugely important to our success. Otherwise, we're going to discredit the notion of impact because people will say, look, it's another form of marketing. And I want to ask Dolika a question, if I may, Colin, which is about accountability of governments in Africa and in the Middle East and in Asia. Because I believe, and I believe, Dolika, you shared the view, that these new tools of impact increase the accountability of the governments whose policies they seem, they're designed to promote.
So Ronnie, you make my job easy. Dolika.
So look, I think the point that you raise, Ronnie, is extremely important. And as we speak about impact transparency, you come at it very much from the transparency and accountability and the reporting of our global businesses. And that impact is across the impact on the populations, the creation of jobs, the pollution, the climate-related damages, etc. Getting a balanced view of that level of impact. I think impact also has the other side of it, which is the question that you ask of me. I think that the role of the recipient countries in this new dimension or conversation that we're creating becomes extremely critical, especially when we think about the fact that the budgets of a lot of our traditional donors to emerging markets are going to be tightened because of political changes, different ideologies, but also because of the cost of recovering from COVID within those countries that have traditionally been very generous with their humanitarian budgets and so on. That means that the recipient countries of or emerging markets that are typically the recipient countries of impact investing and donor funding and humanitarian aid, this is going to be a beauty pageant. This is going to be present yourself in the most amazing light that you can convince me that when you win this prize, you will go out there and you will become an ambassador for what we believe in. And I go back to my three-dimensional thinking, which I think is where the world is going to go, which is foreign policy is going to merge with development, is going to merge with investment, and is going to require desired outcomes. And so for us, for me as a Zambian, I have to go to my government and say, if we want to get money out of FCDO, we are in a race and in a competition with 80 other countries. And this is what we need to do. And the taxpayer that FCDO is accountable to is no longer, as you alluded to, Ronnie, is no longer going to be as patient with just dishing out funds and not realizing what is going to come. We've been talking the poverty story for the last 50 years, for the last 100 years. What has our money been doing? So there's got to be on both sides a level of accountability so that transparency and responsibility and the paying for success and being able to show that our women have access, that the slums are actually towns. We pay for infrastructure. Our countries have raised bonds. Half of Africa is in debt today because it went to the markets to raise bonds for infrastructure development. We still have slums. So that kind of narrative of we are a sovereign, but we'll take your money, I hope I'm not being too political and crossing the boundaries here, but for me as a non-politician, but also thinking of my younger generation who are much more discerning about these things, that is not going to hold anymore. So it is time, I think, for us to think about what has been our humanitarian budget, for example, over the last 20 years. Can we put a portion of that? We don't need to create new money. Can we reallocate some of that into, for example, financial instruments that are low-hanging fruit? We don't have to create new instruments. We can scale and replicate instruments that are already out there. For example, FCDO in my country of Zambia, and I'm sure they're doing it elsewhere, has actually worked together with the central bank, together with the private sector, to put up a bond that is specifically designed to help SMEs to build back better after this COVID interaction. Again, FCDO in Kenya has issued green bonds. They've issued gender bonds. And so the instruments are there. Let's just scale them and replicate them. But let us also hold our recipients accountable. When I borrow from my bank, I'm accountable to the bank. They can take my house if I don't behave.
Okay, let's take some questions now. And just to remind our audience that they can ask questions through the Q&A function at the base of their screen. So first question, Ronnie, to you on this notion of this impact-weighted accounting. And the question is, are the tools for monetizing the various types of social impact sufficiently advanced that you can actually do this type of impact weighting?
The answer is yes, Colin, and I would direct everybody to HBS, IWA, Harvard Business School Impact Weighted Accounts. you will see there, among other things, a data set of 1,800 companies, public companies from across the world that have disclosed 80% or more of the environmental information we need in order to measure all the environmental impact. Now, to give you a peep into the future, Colin, if I say to you that 250 of these 1,800 companies create more damage than profit in a year, that more than 600 create damage equivalent to a quarter or more of their profit, that together the 1,800 companies deliver $3 trillion worth of annual environmental damage. And that you can already see in the data set the correlation to which I referred about higher pollution and lower stock market valuation relative to competitors. And if you then extrapolate that to measuring the diversity of the workforce, allocating the remuneration levels to the missing people relative to the demographics outside of the company, measuring the disparity in pay between gender and ethnic background and so on and so forth. And that for a company like Apple, which has a $10 billion annual US wage bill, this leads to a negative charge of $2.7 billion in terms of impact. Then you can begin to understand how impact accounting can, if monetized and expressed through financial accounts, can really begin to inform investor decision-making. Now, the question is, having defined all the pathways to monetization, which we have done, we have prepared a framework for monetizing impacts, which you will see on our website. Who sets the prices? Who sets the price for a ton of carbon emission? When you've got signs telling you it's $300 a ton, you've got a carbon credit market that says to you it's anywhere from $5 to $30 a ton. I think the answer is, just as we've done with financial accounting, an impact accounting board is going to have to pick the best objective measure. The aim of impact accounting is to portray in accurate terms, as accurate as we can, the actual damage caused. So it's not to provide incentives through the accounting system. That's for government to do. And what I can say is that we do have the ability today, because of the massive work that's being done, both in the environmental and in the employment area, actually, to bring a ton of information to inform the setting of new impact standards of this kind. So I believe, in answer to the question, that if governments today mandated that companies starting 3 years from now have to publish impact-weighted accounts covering all of the different impacts to which I have referred, that companies would be able to do that with the help of their accounting firms. And to the obvious reaction, well, isn't that heaping too much on these companies at the time when they have enough on their plate? The answer is, compare the cost to the $3 trillion of damage, which government is having to clean up through taxpayer money. And it's a tiny portion of the cost involved.
I'm sorry, may I just piggyback on what Ronnie has just said? Because I think it's extremely important. Once again, I want to make that comparison that the conversation we're having, it has got two sides, two constituencies to it. So what Ronnie is saying in terms of getting those numbers out actually eases the conversation between the bilateral relationships of countries. Because, for example, what you've got in much of Africa right now is a resistance to follow certain climate-related constraints, for example, coal and fossil fuels, because they say we are not the ones who are emitting this damage that has been caused to the world. It is those industrialized countries. But if you have very clear numbers, the data is out there, then you have at the table a much more sensible conversation around actual facts and actual numbers, as opposed to you polluted, we are now suffering, and yet you want once again for us to suffer by directing us to do certain things. So I really think this concept of impact accounting is bigger than we might even appreciate at the moment.
Okay, thanks a lot, Dalika. We have time, I'm afraid, I think, for only one more question, and I'll ask it of you, Dalika, which is pension funds, or you could say institutional investors, when faced with the data about their diminishing investing in developing economies, often identify regulatory risks as the barrier for making those types of investments. Both regulatory risks at home in terms of capital adequacy weighting, and also regulatory risks in the countries themselves. And the question is that real or is that imagined? Is it genuine or is it an excuse?
I think it's a combination of both. I think that there is a genuine concern in the, as we speak today, things happen in countries that as an investor who is also looking after taxpayers' money, and typically this is the largest pension funds are looking after government employees. And so you really cannot afford to make mistakes around these conversations. So unfortunately, what we see of the world is what is published about the world. And on emerging markets, I'm afraid that the noise around the regulatory and political disturbances far overshadow the opportunity. So M-Pesa came out of Kenya. And Kenya is a country that in 2008 had people apparently with pangas killing each other because the election had not gone their way. So there is an element of truth to it, and I understand that risk. The further away you are from understanding a risk, the more difficult it is, the less palatable it is for you, especially when you're handling other people's money. So I think there is a reality to it. Having said that, I think there is also an excuse of people not want to come out of their comfort zones. If I can sleep at night and make my return within my boundaries of X amount, and I don't have to worry about whether Uganda has blown up or Zambia has blown up or Myanmar has just changed its regime, then I would rather do that and promise my payers or my shareholders a smaller return, but it's not the optimal return. And a responsible optimal investor has the responsibility to go beyond their comfort zone, but to structure for that risk. So there is an element of truth in both. It is an excuse, but there is an element of reality. And I take that reality back to our countries as recipients of, or the most needy of this capital, that we have got to make our countries, I think somebody once termed it, predictable. You can be predictable in one way, in a positive way, or you can be predictable in a negative way. The opportunity is still there. But if it's predictable, I can structure for that opportunity. So there is a responsibility on both sides.
All right, thank you very much, Dalika. I think those are the only questions we can take. We have quite a few questions. I can assure everyone who had a question that hasn't been answered that we will share them with both Ronnie and Dalika after this, after we wind up today. But now I'd like to pass it back to Nick to give some closing remarks and to wind us up today. Thank you, Ronnie. Thank you, Dalika. Over to you, Nick.
Thanks, thank you, Colin. Thank you, doing a great job as a compere, as always, on these Insight events. Thanks again to Ronnie. And I also wanted to obviously thank Dalika. You know, I always say when I'm introducing Dalika, and I've had the pleasure of doing that also many times, that she really is the most inspiring voice for Africa. and always does a fantastic job. So thank you, Dolika, for being here, and thank you for your role at CDC as one of our non-executive directors. I suppose I'm left with sort of three broad thoughts. I mean, one is this question of what comes through very strongly when you listen to Ronnie and to Dolika is the sense of timing, and that, as I think Dolika said, the time is now. Ronnie has talked about in his book and previously about this being a tipping point. And it's sort of the coming together of, the one hand, a significant change, as Ronnie said, in values. And the value system, particularly for young people today, is very different from the one we had a couple of decades ago. Whether it's what they spend or how they invest or where they work, there has been a significant change which enables impact investment. And I think the other thing that Ronnie mentioned too is around technology. And we've thought in terms of technology as being a huge enabler for young entrepreneurs to build businesses, among sustainable businesses, among low-income groups that perhaps wouldn't have been possible before. But I think that is a critical issue. But what Ronnie's point also was around the opportunity for technology to allow us to learn more and to measure more and to affect behavior in that way. And that is a very powerful, that's a very powerful change. The second thing I think is around this sense of urgency, and we talk a lot, obviously, about COVID and the huge challenges that that's imposed around the world. But I think when you listen, and I think Dolika put this very well, COVID in Africa is a symptom of the development challenges that were already there before, and whether that's health systems, poor health systems, or whether that's the challenges of getting young people into productive employment, or whether that's the lack of access to power. All those things and many other challenges, all those things have been there before, but what COVID has done is it's sort of magnified those and brought them into and made them even more urgent. And thirdly, I think what comes through very strongly is this sense that this is not a challenge for just one person or just one group or just one type of institution. This is a challenge for and an opportunity for everybody, whether that's governments or whether it's investors or whether it's corporations or whether it's foundations. Everybody has a role to play in moving to a world where all investment is impact investment. But I also, and I'll close with this, I find it, I always find when I listen to people like Dolika and Ronnie, I come away with a real sense of optimism. You know, I mentioned when I was introducing Ronnie, the Social Investment Task Force, founded in 2000, 20 years ago. If you read the report of the Social Investment Task Force today, and it was a fantastic and sort of innovative piece of work, but we have traveled so far since that time over what is, within the overall scheme of things, a relatively short period of time, that I think you have to be optimistic, and we have done that because of the leadership of people like Ronnie and Dolika. So I think, you know, from my perspective, CDC's perspective, all of our perspectives, we want to thank you both for being here today, spending the time with us, and for all the fantastic work that you have done over the last couple of decades or longer and continue to do today. So thank you very much, and thank you all for joining us.
Thank you, Nick. Thank you for all the fantastic work that you do. And Colin, thank you for moderating the session so well. And Dolika, as always, thank you.
Likewise. Thank you so much.
Bye-bye.
Bye-bye.